Bismillah, welcome back to Trade and Wait. Today we will review price action for today, January 15th, 2025 on the E-mini S&P 500 futures, the March 2025 contract. This is the 4-hour chart here, and this is the 15-minute. I'm going to take that off because the chart is already crowded, and this is how you do it. Already a little noisy. Here we have the weekly. This is a weekly. I guess right now we can just make it a little bit clearer. Weekly inverted fair value gap. So right now it's a reclaim bullish fair value gap because price is traded back above it. So we'll see if that still holds. Tomorrow's Thursday, so typically there's a probability, I'm not gonna say high or low, but that tomorrow may be a reversal day. So that's there. So we'll see. My bias is still bearish. Apologies. I'm still looking for price to trade into this fair value gap that I'm typing the words on. And so in the previous video, I kind of highlighted this down close candle as a bullish fair value gap, and I said if price holds above the high of this inverted fair value gap, then I will consider a bullish run. There's a possibility that a portion, well, it already stabbed into this wick, but you think in terms of internal range liquidity to external range, then possibly this can be a target. This is a bearish breaker here, this down close candle, so we can kind of anticipate a short situation here until price breaks above and holds. Or I can trade into here, who knows, right? So this is all theory and all different possibilities, and as usual, it's kind of driving off the 6 thinking hats, right? So that would be green hat thinking. This kind of like calculating the different possibilities of where price may go and how price would get there. Right, so that's that. So today I want to kind of touch on the 4 types of trades highlighted in Adam Grimes's book, The Art and Science of Technical Analysis. And of course, he's referencing Whitehall's market cycle. But there are 2 trend types: trend continuation and trend termination, and 2 support and resistance trades, holding and failing. Because every technical trade imaginable falls into one of these categories. Trades from certain categories are more appropriate at certain points in the market structure, so it is worthwhile to carefully consider your trades in this context. So he gives a reason here. First, you should become intimately familiar with the patterns associated with the failure of your patterns you trade. And it's not here, but secondly, the second reason is related to self-control and psychology. There is an old saying: if the only tool you have is a hammer, every problem you encounter will look like a nail. If you are only a skilled breakout trader, you may find it difficult to wait for the excellent breakout trades and may try to force suboptimal patterns into this mold. If you have the freedom and the skills to switch to the setups that match the market conditions, you will be able to adapt your trading skills to the market environment. There is certainly room for the specialist who does one trade and does it very well, but many traders find success with a broader approach. Anyway, you want to kind of group your trades into this type of framework if possible, right? Trend continuation, trend termination, right? Continuation patterns or failures, right? False breakouts, etc. Pullbacks fall into like the trend continuation pattern as well. OT entries, for example. So it's the reason why I wanted to highlight that. So these are the weekly levels relevant to our current situation. where price is. Let's all right, so we already discussed this in the previous video. You have a 4-hour order block that's here. Price traded down into this violated bearish fair value gap, making that an inverted fair value gap. So inverted fair value gaps and order blocks, once they are created, so to speak, they are generally seen as a change in the state of delivery. So here it's the violation of this this bearish fair value gap. This becomes an inverted fair value gap plus the order block. That's a nested PD array. Now you have an inverted fair value gap plus an order block, and you have a previous fair value gap way back there. If you miss this one, then really it doesn't really matter, right? But if you saw it, you saw it. It's useful, right? So this is a pullback here into this inverted fair value gap, which means ideally is a continuation pattern. So here we have price staying inside of, and I left the previous day's high here from Monday. This is what we used on Tuesday as a target and as a source of resistance. Price fell in, right? Failing to hold above this previous day's high, this Monday's high, and the failure or the pullback into this these levels here. I can throw the fibs on here so you can kind of see optimal trade entry. It's showing quarters now because I used the quarters of wicks on this time frame, and quarter of this. This is actually quarters of this 4-hour. Of this 4-hour bearish fair value gap. So there's two things we can. Wait, let me. I guess I should make that bigger. Too big, right? Such thing is too big, huh? All right, so we have this low and this high here, and then we have this entry here. So this would be first profit. I guess maybe this would be first profit. This would be first target, second target, and it didn't get to 1 standard deviation of this range yet. If you use, because we do have like a working theory regarding like long wicks. If you consider this to be a long wick, then you may exclude it, right? Just use the highest body and the lowest body here. And we have optimal trade entry. Now we have 1 standard deviation. You have a tighter range because you're just using the bodies. And how does it go? It says it's twofold, right? The bodies of the candles are where the bulk of the volume is, as opposed to the wicks, right? That's that. And the second one, let me see. Oh yes, and the second one is the bodies of the candles tell the story, and the wicks do the damage, right? The bodies of the candles tell the story, and the wicks do the damage. So that's kind of what I was touching on here, where price was stabbing through this weekly fair value gap. Weekly, at the time, bearish fair value gap. That's reclaim bullish fair value gap. But anyway, stabbed through there, the body stayed below the high, so this gives more validation that price may fail, right? May fail, pull back to pull back, or trade lower inside of there, or break below. And you can see how Price pulled back inside and held above the consequent encroachment, pulled back below, kind of this consolidated below consequent encroachment of that. And yesterday or last night, we did highlight that price had pulled down and was consolidating inside of the Asia range. Inside of the Asia range and the new day opening gap. Well, that's what we pointed out. Yeah, this one here on Monday. So price was consolidating inside of this gap, inside of Monday's new day opening gap, and also the Asia range. It was consolidating here. I think I highlighted it was consolidating inside of the previous, inside of Monday's Asia range, which is high here, low here. That is Monday, right? Yep. All right, so that's what we denoted yesterday, and you can see it better here that price was trading and price traded above, used that as support, the consequent encroachment. This gave validity to prices going higher. Likewise, price consolidated around the previous day's high, which is Monday's times 2, right? As I like to say, the highlighted previous day's high here. Let's take these circles off. Point for that is made. Anyway, I left this here because it literally reclaimed the previous day's high, this level here. Reclaimed that here, and this was partially a reason for you to go long here. Another reason for you to go long here was, right, because what's the narrative is, so you have a volume imbalance here. So the rules are you incorporate that into the fair value gap. The one thing about trading these concepts is you want to the narrative. All right, let's make it's kind of big already, but whatever. Narrative is what? One, it's where is price coming from? Where is it going? And 3, how will it get there? And that's the punchline, right? So you're going to utilize this higher time frame as we discussed previously, right? In terms of triple screen or utilizing one of the methods of utilizing higher time frame or intermediate time frame, which can also be the trading time frame. That's what TTF stands for, the trading time frame. Or you can go lower to the short term or the shorter time frame to look for better opportunities or quicker reversal patterns, continuation patterns, or as we know, right, support and resistance type patterns. So the higher time frame is you always want to trade in the direction of the higher time frame, and is for you to determine based on your trader identity what time frame is that higher time frame. And of course, we use the weekly time frame to kind of give us our weekly directional bias. However, if you are like putting on trades, for example, you may based on your trader identity, you may use other time frames. In our case, is the 4-hour time frame as our higher time frame. So you could utilize ICT concepts such as internal range liquidity to external range liquidity for those reasons. And that's pretty much what we have here, right? We have the low, we have the high here, we have the retracement here. So then we have price consolidating at this level here, and then on the lower time frame, we see our opportunity, right? So it's like, okay, so we have run on stops. You could even say this the run on stop. This the 10 a.m. candle on Friday. Run on stops, run on sell side liquidity. We have the run up. We have the break in market structure, which is the previous day's high, Monday's high here with this candle, right? That's a swing high, break in market structure. And the rules are, so we have the other rule, right? The A plus trade setup rule, right? A plus trade setup rules. What are the rules, man? Do you know what the rules are? Anyway, it's not a rule, but it's the mantra, right? Day by day, in every way, we're getting better and better. Day by day, in every way, we're getting better and better. Day by day, and in every way, we're getting better and better. But what are the rules? Can anybody tell me what the rules are? Obviously, I'm gonna just go ahead and let you know. So rule number 1 is a run on stops. 2 is a market structure shift. And 3 is a pullback above or below, depending on market direction, 50% of the range that created the market structure shift. Into a PD array, a premium discount array, such as an order block, such as an inefficiency like a fair value gap, such as a breaker, right? Such as previous day's high, previous day's low. All of those things are valid. PD arrays, for example. So yeah, PD a pullback above or below 50% of the range that created the market structure shift into a PD array or what? PD array or in always just differentiate between a PD array and efficiency, just to make that clear that we are looking for generally like internal range liquidity. It could be external, like because you want to see price run stops before like make a huge move. In that case, if it's running stops, general is running stops, that would be external range liquidity, at least in that smaller scope, right? So those are the 3 rules. Doesn't include the rules for stop loss placement or protective stop placement, as well as targeting. Doesn't include that. But this is the back of the business card, A plus trade setup for me. This is what I look for. And we have that here. But this entry was on Tuesday. You missed this entry, and you look for another one, right? And you have like, so even if, all right, so we don't really talk about all of the PD arrays because we don't need to, right? But you have this, right? This liquidity void, aka volume imbalance, whatever you want to call it yourself, as long as you can recognize it when you see it. So we have that. That's a reason to continue higher, right? Because you can see here now, just highlight it right in front of you here. You can see price. Again, the wicks do the damage, the bodies tell the story. You can see here, price is reacting quite nicely to this. It's actually holding. The wicks are just taking liquidity, running all this, cleaning all this imbalance up, trading into this. If you didn't see this, or you don't trade inverted fair value gaps, you had this fair value gap here for entry. You had this volume imbalance for entry, and it's good, right? All good, right? So that's one. If you don't use it, you don't use it. If you saw it, then you saw it. If you didn't, then right? It's all spoiled milk. Don't worry about it, right? Just clean it up, right? Where we at with it? So we have optimal trade entry from yesterday. You missed it, then you could have used another strategy to go long. If you don't see it on this time frame, this consolidation is not like convincing to you, then you could have went to a lower time frame, the 15-minute, for example. And we have Asia range, and that's what this blue line is. And that's the time frame that I put it at. You can put it wherever you want, but that's where I put mine's at. And I only brought it up so I can throw some labels on there so you can actually see that's Asia high, Asia low. I just, the charts get kind of like clunky, so I usually don't leave the words on there. Anyway, you can see during the London session, run on the Asia lows and the rally. So you see, like, all right, characteristic of the Asia range is a consolidation, and you can see now that it literally consolidated inside of that volume imbalance. That is something I did not see, and this is why it's like, oh, I'm not coming on here acting like I'm some type of rocket science. Like, I did again start out with like ICT concepts. I did feel like, hey, I needed to know more like the professional side, so I kind of like tried to like accumulate different learning styles in order to become that more professional grade trader, in my mind at least. And I did receive quite the number of setbacks due to that approach. But anyway, we can see price now inside of this volume imbalance accumulating liquidity that's in there, that's registering, it's accumulating orders. And you can see here it ran sell side, the Asia low, ran up, ran buy side, the Asia high, and it also traded. So that's a 15-minute. This is a 15-minute bearish fair value gap that you can see price was reacting to, and that's that. But that's your pullback here. That's your pullback, and so you got this low to this high. Optimal trade entry long at 515 into 61.8. If you missed that, then it's all your fault. No, I'm just joking. If you missed it, then such is life, right? You missed that run. Let's see. I put a 9. Yeah, pretty much made 9, almost 9 standard deviations from that entry here. But if you missed that, then that's okay, right? Right. This is the news, and this is the point I wanted to make. Like, this is why this is highlighted, because this is a swing high. This is a target, right? So if you think about what's the next strong liquidity, if price was to take off from here, it would be, because the setup is based off of 4-hour pattern. So therefore we should have 4-hour targets, right? 4-hour targets. So the first target would be this swing high, and then this swing high, these relative equal highs. And then we have this, right? So all of this is also targets, but you see price blew through all of that. So you say, I mean, like you think about like police chases and like, where do you think the spike strip, where do you think they're going to throw the spike strip at, right? This is where this was laying in wait right here, this big glue trap. Slowed it right down. So eyeballing it, this is about consequent encroachment of that. Right. Oh, we actually don't even need to eyeball it because I already did it. It's right here. Didn't quite hit it. I eyeballed this too, so it could be a little off, but who cares, right? Good enough for me. You can do the more accurate approach if that suits you better. But anyway, this will be a reason to consider getting out here. But yeah. So that's that. And the reason, and this is why I got into the story about the narrative, right? Where is price coming from? You can see it. It's coming from a retracement on a 4-hour chart with a huge confluence of strong bullish PD arrays here. Again, the 4-hour order block, 4-hour fair value gap, 4-hour inverted fair value gap. Pushed higher, held above this volume imbalance. It's singing to you. It's telling you like, yo, like, you may not catch me, but this is what I want to do, right? this is all technical patterns. We didn't even get to the news catalyst, like into the news catalyst. Like, but this is something to note is that, oh, what news was today? What type of news was today? This was CPI. Tomorrow we have high impact news again at 8:30 on unemployment claims, right? But all right, CPI. Now we can kind of go, right? Like using the same narrative, like where is price coming from? Where is it going? How will it get there? But also, this is a consolidation. Consolidation, manipulation. That's this, all these wicks stabbing down here. That's your pullback, right? It's all about how do you tell your story, because the manipulation was the pullback. That is your continuation pattern, right? So you had your consolidation, manipulation, pull back in, consolidated a little more, and then you have distribution, right? Distribution holding above the 4-hour, the weekly inverted fair value gap, consequent encroachment, and on the lower time frame we have a bullish fair value gap that price stabbed into. Then it kind of like consolidated above Monday's high, so it reclaimed. So you got your support and resistance play now, right? So we have a trend continuation. We have a trend continuation. We have a trend failure to some degree, the pullback, right? The manipulation. We have a support, resistance turn support, which is the CE, the consequent encroachment of this weekly fair value gap. And we have, again, the previous day's high resistance. You can see it here, like fake out. Oh, it traded above. Oh, it failed. Oh, it traded back up. It closed above it. Oh, the wick stabbed through, but the body stayed above it. Again, so the bodies are telling the story. The wicks are doing the damage, right? Bam, bam, bam. Again, this is a 15-minute time frame, though. So, all right. So that's strong to me. That's a good story. That's like you mess this story up, it's good night, right? Because this is an account maker or account destroyer, right? Like if you put like too much size, or you trade in the ES and you should have been trading the MES, this will wipe you out. But it would also, so this probably put smiles on some people's face and put frowns on other people's face, right? Like I gotta go back to work and make that money back. We all know the feeling. Stop acting like you too cute for failure, right? So yeah, we have this big bull bar. Big bull bar trading, that's at 8:30, and we already justified this technically. So technical catalyst with a fundamental catalyst, that's like premium A+ setup. Like, yo, talk to me nicely, bro. Like, you playing around, talk to me nice, right? Like, if you had a trading plan for this, and again, I just want to reiterate that what I was focused on this week, the rest of the month, rest of the quarter, is only taking. Let me reword that, right? How you say it, right? Like taking or reducing impulsive trades. Only taking trades that I have a trading plan for, or adhering to the trading plan that I actually did take the time out to formulate. And the other thing is thinking in terms of R, kind of like my entry to my protective stop. How much is that going to cost me if price did go against me and I got like ideally stopped out? I don't want that to be too big of a size risk for my account, like destroying the account. And likewise, how many multiples of R? And in this case, I use standard deviations, but you can easily use the distance between your stop and your entry as projections, right? Multiples of R, multiples of risk versus reward. So we kind of we here 8:30, right? You the type, hey, you trade in SPY or something else. Hey, I don't trade pre-market, right? Cause that's 8:30. I ain't messing with that, right? So you could kind of like partition this off into quarters. I didn't do that here. I didn't do that here. I'll tell you what I did do, or an approach that can work, right? So this is your 930 candle, which will be like ideally like a manipulation, and this will be breaking this wick into quadrants. Additionally, what I did also, I'm gonna take, you can see here it fell like 25% of this 4-hour bullet bearish imbalance, right? Okay, and it fell to halfway, the CE of it, the consequent crouch, the midpoint. But I'm gonna take it off because should I just take it? Should I just delete it? All right, so you see that. But what I did do was when price was down here, I broke this into quarters. And this is why I don't leave the words on there, because it gets in the way. You're in the way. Get out of the way. Anyway, that's that wick here. And you can see like we treat gaps like we treat wicks like gaps. There's a whole bunch of concepts being thrown at you. It's a whole bunch of concepts being thrown at you, but they all have significance, right? All right, this is 930 candle manipulation. You can have an open and drive play targeting this swing high, like where you going, right? So what I was expecting was exactly what happened here, but I wasn't. I was hoping that price kind of like took all this liquidity back, right? But you think in terms of like ATR, right? Average true range, or average daily range, and you're like, oh, price already made that type of move for the day. So is it realistic that price will come back and recoup all of this huge run up today? No, right? Can it happen? Sure. Is it realistic? No. No. So, all right. So we had this pullback. One of the characteristics of 930, and this is the 15-minute chart, so that's 930 to 945, is a manipulation leg. And because we don't have any break in market structure on this time frame, we can kind of conclude that price will continue higher. Price took out this swing high, and with this, so that's a break in market structure again, and we have a pullback, right? So first off, we have a run. It's like so many things, right? So we have a run up into this 4-hour bearish fair value gap. So we can kind of like anticipate at a very minimum a pullback or a reversal to some degree, right? But because there's no break in market structure here, we can kind of continue. We can kind of conclude that price will continue higher. Likewise, we have that swing high. This is that same swing high over here. Let's make it jump, make it bounce for you a little, right? Anyway, that's that level, right? That's that level, right? So this is resistance. You can treat it as resistance turn support. There you go. And it's pretty much 59, 59.25. And 59, 59.5. That's pretty good. Who cares, right? You're not really looking for precision. You're looking for profitability, right? So I'm not taking shots. If that's your thing, that's your thing, right? But it's okay to get a little sloppy, right? It's not really sloppy. It's just not like I'm not that neat in real life, I'm not that neat, right? Like, I don't like to eat with my hands, Let me cook. Anyway, so treat gaps like wicks. Oof, I'm tired. Treat wicks like gaps. Treat wicks like gaps, and we broke the wick into quarters, like we do the gaps. All right. So we have that pullback, and you see price, the bodies of the candles, one holding above this swing high, this resistance turn support, and we also have price holding above the consequent encroachment of the wick. And again, we didn't have a break in market structure because there's no structure over here to break, really, right? On this time frame. So we have this run here. So ran stops here, pull back, because again, there's no break in market structure or a market structure shift. So, and we already pointed out, holding above that previous resistance, and is also holding above 50% of the wick. So that's also an optimal trade entry potential, right? Let's see. I don't want to. This is about to get crowded, right? But whatever. You guys, hopefully, you guys are following. We had 36 minutes. About to end this. It's about to be over. Anyway, 78.6 is over here. And you can see here, 78.6 is 59.61. And let's see. That's kind of like price reclaiming level 2. This is the opening price, 59.61. Let's make that bigger because, all right, 59.61. So, right, so that's good. That's optimal trade entry long, targeting this intraday high, and it took it out. And then, like what happens when any form of liquidity is taken out, there's usually some type of reaction to it. I don't want to say pullback, but there's usually some type of reaction. So just like here, right? Price took out this swing low, then retrace, came back, kind of like slowly bled out. Took out this swing low, then pull back, and took out that swing high, then drop. You know, so it's always these types of. So it took out this swing low, then pull back, right? Didn't go all the way back up to it, but it did something, right? Anyway, let's erase that because this is getting noisy, but we can see this is first profit. You get out, right? You're not really like price reacted like big bull bar, right? That's enough to make your eyes open wide, like tops and bottoms, like, you know, something maybe not be right upstairs, right? This is a big bull bar. So you're not really expecting this type of move to occur again, and especially again, you're thinking in terms of an ATR, average true range, or average ADR, average daily range type of move. You're not looking for this big bull bar again. So you're gonna take what you get, take what you can get, right? And that's good. If you listen, man, your risk to reward is good. You don't need like huge price runs. You don't need this big this big bull bar to be profitable. You don't need it. But if you risk the appropriate amount, you have a fairly decent entry, you know, not the best in terms of precision, but, you know, like I mentioned, if your normal life is, you know, that's not how you get down, then, you know, do what you do, right? But be responsible, right? Hold yourself accountable. So, right, have a plan like we have here. So yeah, so we have this wick. You can see here, price traded back inside of the wick. And you can see each level is kind of like, price is kind of like, hey man, I'm using you to like, let's walk on all over it. And this is like so balanced, right? It's like not leaving any gap. It's like, yeah, we pushing along. We got a little gap here. Still trucking, made a swing high. Pull back. Took out that swing high again during power hour, 315. And then pull back down to the bottom of the wick, or whatever you want to classify it. Because also, this is something I'm pondering too, right? Because this is technically it's a breaker, but if you go wick to wick, it's not a breaker, right? Either way, it's a mitigation block because this used to be, you can see this as a order block that's been violated, which means that it's a mitigation block. So if you do body and exclude the wicks, then you have a low, high, lower, low. This makes this a breaker. Okay, right, all right. That's a conversation to be had, right? But yeah, this is how I see it, right? But anyway, we're gonna talk about what we do see on the chart, but I'm just keeping true to my form, and this is just not a review. This is also a discovery. That's something we can. Well, I'm gonna dig into it a little. If I like some stuff comes up, like I like to look into. I like to jump down rabbit holes, but sometimes it's better not to do it because I got bigger priorities, right? So I mean, I get into that, but I would see that as such, regardless if it's a true or not. This is still something I would kind of look at, like, oh, the body is telling me there's something to look at, right? Um, so I think that's good enough for now. If you have any questions, feel free to reach out. Please like, comment, subscribe, and stay great. Deuces.